What's up? Thank you so much for joining this podcast. And this episode, we met with Wayne Martin again. It's our third or fourth time meeting. And we did another debrief of the first half of the year of how and what's going on with the real estate market. You definitely want to tune in. Wayne is a plethora of knowledge. He's super knowledgeable. He's been a broker for a long time. And I hope to see you soon. And thanks so much for joining. All right, we got Wayne Martin here from Real Estate One here, and Wayne, you've been in this market for a very, very long time in the Shasta community market, and this is our third or fourth time doing a market update.
Yeah, that's right.
I love doing it.
Yeah, this is the perfect time because we're, midway through the year, and so we can really talk about what we've seen in the marketplace and where it's going.
Yeah, like what's happening, what happened the first half of the year, and where do we think it's going to go the next half of the year?
Right, and there's some questions. We were talking about politics, or at least the election. How does election affect housing, and what does that mean? And so we're going to jump into that too.
Yep.
And talk about that.
Yeah, I get a lot of clients that ask me that question.
Right, and then another question that we're going to cover is, maybe you're in a home and you're kind of vacillating back and forth about moving up, down, or around, whatever. And we're going to talk about some strategies that will help you find the house that you truly want, because the inventory is low before you lock in selling your home.
Yeah.
And so there's a very specific strategy that we use to keep in control so you can get that next dream home.
And I would bet that there's a lot of sellers or people that want to sell that just are worried about that.
Absolutely.
And the only reason why they're not pulling the trigger is because they don't see a house they love.
Right. And there's a way to do it. I've been in the business pretty much all my life, but really focused on Redding area for the last over 20 years. And so it's very specific to Redding about how we go about it, because it's a little more tricky here than if you were in the city. So because we're more of a rural town, there's things that we have to look for. So, but we'll jump into that a little bit later on. But let's start with a recap, right?
Yeah. Let's go over the recap. So what we got here, thanks for providing these statistics here, Wayne. So we got the year to date up to the end of June. And then we also have the month of June number. So, So you want to start by going off of the year to date?
Sure.
What we got here?
Sure. Okay. So year to date closings, we're down about 20% in transaction volume. So, that's a significant drop as far as the number of transactions.
So 1,140 total for the year.
Right.
1,140 divided by 6, that's 190 transactions per month.
Per month, approximately.
Yeah, per month. And to give our audience some relate that to a couple years ago, what was that? What was that number per month? Like how many transactions per month?
It would probably be double that.
So like 300-400. Yeah,
more
300,
like
400. Yeah, okay.
300-400.
Okay.
Just depending. I mean, a couple of years ago was COVID, and we can't really kind of go by the past. It has been a crazy ride since 2007, 8.
Yeah.
It's been wild,
yeah.
man. Yeah. Anyway, but taking a look at last year, year before, when interest rates started to rise, after we had this meteoric rise in equity, right?
Yeah.
It just went wild. Almost 20% in 3 years.
Yeah.
So that's a pretty significant rise for real estate.
Yeah.
And what's interesting is it hasn't really tapered off, and I don't expect it to taper off.
What do you mean by
pricing?
That? You mean tapered off, meaning it hasn't declined from there? It stayed pretty.
It stayed pretty even,
and maybe going up a little bit.
Yes, and we're going to talk about that. We'll jump into that. When you start looking at average sales prices over the last 3 years. Actually, let's just talk about that right now.
Yeah.
So the average sales price in 2022 was $428,800, let's say. And these are statistics done by appraisers.
Yeah.
A leading appraiser. I want to give a shout out to
Sprinkle.
Yeah, Sprinkle. He's awesome. What a great group. If you need an appraisal, They're amazing.
Yeah.
I highly recommend that you go
Yeah.
with Bob Sprinkle. There's a plug for you, Bob. So, but it's true. So the other thing is, 2022 was 428.8. 2023 it dropped to 421 and change. Now this year, 6 months into it, it's up. Let's see, almost $4,000. So $425,000.
It's inching up there.
It's inching up.
Yeah.
And it shows in our other statistics that we follow, year-to-date statistics. The average sale has been around 402,000.
Yep.
And change. And so it's jumped in 6 months almost 1.9%.
Almost 2%.
Almost 2%.
Yeah.
Yeah. Think about that. 2% in this higher interest rate in 6 months. So it could potentially rise up to 4%.
Yeah, it's
even
trending
5%.
4%, 4 to 5%. Yeah.
Yeah. So as far as new listings are concerned, we're up 5%. We have about 1,800
And what's
new
that
listings.
5% is, how many do we have right now, would you say?
How many listings?
On the market? Yeah, it's
On
like
the
600
market?
and something, 6 something.
Let me look and see. Active listings. Yeah, a little over 600. I got it in this particular.
Oh, okay. Yeah, a little
Yeah.
over 600. So that's up about 5%. Nothing alarming. Is that alarming?
No. And what's kind of interesting, we were talking about this a little bit earlier. There's what I call them junk food houses, and then there's healthy houses.
Yeah.
So what I mean by junk food houses is we're seeing inventory sellers coming on, and their homes are not prepared for a good sale. They need roofs, they have pest work, they have decks, they have all these things.
Yeah.
And the sellers are thinking, well, it's just a seller's market. You know, there's not a lot of inventory. I'm just going to be able to move that. Well, those properties that are listed like that are overpriced, you know, they push the price. Then what they do is, myself as a realtor, I use those houses to sell the good houses.
Oh, interesting.
Any good realtor will do that. It's like, hey, this is your money. You could be buying this thing and pump another 50 grand into this thing, or you could buy this house over here. It's pretty much done.
Yeah.
And it makes the sale of the nice houses easy, and it actually drives those prices up.
Wow.
At the expense of these other ones that are not prepared properly because they either don't have the money, or they're working with realtors that are not telling them the truth about the marketplace because they don't want to hear it. Sellers don't like to hear your house is not at par with the market.
But they need to hear it.
They need to hear it.
They need to hear it, and it'll help them.
Absolutely.
It'll help them instead of just sitting there on the market.
Right. Yeah. Exactly. I mean, any house will sell based upon price.
Yeah.
I mean, that's the truth.
Yeah, it's
everybody goes, oh, location. Well, you can have a crappy location, but if you price it correctly, you're going to sell immediately.
Yeah.
If you're going to meet the market tells you what your home is worth.
Yeah.
Right. There's enough people coming through. They're looking at it. If they're not writing an offer, you're at least 5%, 3 to 5% over market. If you get down in that 3% range, they might be going through and you're getting not necessarily good offers.
Yeah.
But if you meet the market, you can garner a number of offers immediately and potentially push your price up. So the pricing strategy of, I can always come down. Yeah, it's statistically, and I've been doing this a long time, when they do surveys about that, the ones that start high and chase the market down, they always net less.
Then starting lower and
moving up.
Yeah.
Or just meet the market.
Meeting the market.
And that's more of an art form than a science. It's just trying to build a strategy because you're competing against, if you're a seller, you're competing against what will that money buy?
Yeah.
In other homes that you're competing with.
Of course.
You know, that's it. I'm going to show, the buyer as many houses in that price range. And your house is competing with that way.
Yep. Yeah.
Anyway.
Makes sense. Yeah. So to to your point, what you're saying is the inventory's up 5%, but a lot of it's crap. A lot of
exactly.
it's junk. A lot of it's
junk food.
A lot of it's junk.
It's junk.
Yeah. And so if a home is priced well and it's a decent home, it'll sell quickly.
It'll sell quickly.
Yeah.
It might need a little paint, but if it needs a lot of new windows, it needs a roof. Well, those are big expenditures for somebody moving into a home.
Absolutely.
So you also have to kind of think about it. I think about it in terms of if I'm buying a used car and I have good maintenance records and it's really straight, you know, there's no dents or, you know, it might be a little knick-knack things here.
Yeah.
You're gonna pay more for that. But when you have a car that might be just as good, but it's got some big dents or, you know, has torn upholstery, you know, maybe needs some a little bit of engine work, tune up. Well, that creates a lot of unknowns. So if I'm going to buy that car, I'm going to discount it, right?
Yeah.
Because it's effort, it's unknown.
Yeah.
You know, it's like, oh man, this is going to be a hassle. I can just buy this car that's, you know.
And maybe this car gets a little premium for being dialed.
Absolutely. That's the way it works in the real world.
Yeah.
And houses are just the same.
Yeah.
So, you know, for sellers, they need to get their head around that.
Yeah. So yeah, and it makes sense because that's what flippers do. They just go in and they get the discount and then they fix it up and they sell it for a premium because it's dialed. No one, you don't have
They
to.
did all the work, and so they
did all
deserve the profit if there's profit if they buy it correctly.
Yeah. Yeah.
You know.
Yeah.
So that's the way that works. Now, if we're working with a buyer and my buyer's pre-qualified and they might have some skill or they have a brother or cousin or uncle or, you know, aunt or whatever that can do this stuff and they're not afraid of it and they understand it.
Yeah.
Sometimes buying those houses that need work, we can get them a better deal. It isn't necessarily they're going to steal it, but they can build some equity into it going in the door if they're willing to do sweat equity.
Yeah.
So that's a way for somebody to get into. Now, depending upon the financing, now, what about financing? How would you help that buyer in the financing arena? I'm showing them work
for
something kind of a light fixer, needs paint, needs some, you know, a little bit of word work here and there. It's not extreme.
Yeah, we'll finance it for sure. The biggest thing we'll look out for is to make sure that there's no health and safety issues with the home.
Right.
So as long as that buyer can move in and live there day one, you know, then they'll be fine on getting a mortgage for
so
it.
Define health and safety issues
yeah, so
as far as an appraisal is concerned.
Yeah, so health and safety would mean that if you get hurt, potential of getting hurt, and someone's definition of potentially getting hurt is different than what a buyer might think.
Right.
So like, for example, if you go into a house and there's exposed wiring or maybe the electrical caps are off or something like that, that would be a health and safety issue.
Or torn. I've seen it where they've called out torn carpet that needs to be just repaired.
Correct.
Just repaired so it's not a trip hazard.
Correct. Think of health and safety not necessarily for an adult, but for a 2-year-old.
Right. That's a little different.
Yeah.
Here, let's touch the plug. Woo!
Yeah. And so, because the bank doesn't know who's going to be in that property.
Correct.
Or friends, family coming in. You know, it could be a 2-year-old any day coming into that property.
Yeah, absolutely.
So that's
somebody elderly.
That's how they think of a health and safety.
Correct.
Yeah. So, and then there's different loans that have more. They're more. They're not as. They're more conservative, I should say. Like for example, FHA. They're peeling paint as a health and safety.
Right.
Right. So, but we'll work with.
But that's easy to work through.
Absolutely. Peeling paint.
Peeling paint. They'll just brush it off and prime it and call it good.
Yeah.
So it's not something we're not used to, but a good realtor with experience working with a great lender, we can create a strategy to help you get into that home.
Yeah.
And work with the seller and the selling agent. Hopefully we have a good seller that has a good agent that can really understand it, and we can kind of massage the deal and make it work for everybody.
Yeah, absolutely.
Buyer and seller.
Yeah. No, that's good. So Wayne, so that's total up to end of June. Last month, the number of transactions was down about 10%.
Correct.
We had 3 months of inventory for the month of June. And you want to go over months of inventory? I think that's
Sure.
super because that determines whether a seller market or a buyer's market.
Correct.
The month of inventory.
Correct.
So you want to talk
Yeah,
about that?
so I'm going to talk a little bit about that. So on average, in our industry, when we look at inventory, months of inventory, so how many houses are on the market and then how long it takes to sell the average house. So 6 months of inventory roughly is equilibrium between the seller and the buyer negotiating. It's no one has an advantage.
So basically, what the math is there, you take the total number of inventory divided by the total number of transactions happening.
Correct.
That's the number.
That's the number we go by.
Yeah, and then it could be that number could be 3. So what this is saying.
So this is saying 3. So this is basically giving a seller an advantage. If they are priced properly in the marketplace, they will have better terms, and there's a higher propensity that that home will garner more money. And if that continues, that 3 months of inventory continues in the marketplace for the next 6 months, that buyer is going to, probably have more appreciation.
Yeah, benefit from the
The
appreciation.
benefit of the low inventory.
Yeah.
So it's kind of an interesting concept. You go, oh, it's a seller's market. Well, all of a sudden, you have a house.
Once you have a house, then you immediately can become a seller.
Yeah,
you
can, or you're gaining equity as if you have a home ownership.
Yeah.
So that's kind of an important thing to realize. It's like, oh, this sucks.
So what makes a buyer's market versus a seller's market? There's like a
buyer's
number.
market is just too much inventory.
Like a number. So like if it's I've always been told if that number is more than 6 months, then it would be a buyer's market.
Correct.
If that number is less than 6 months, then it would be
it tends towards the advantage of the seller.
Advantage of the seller, 6 months.
Right.
So basically what they're saying here in your numbers here, we had 3 months of inventory. That's basically taking, let's say, 600 homes on the market divided by 200 transactions that were done, let's say.
Right.
And there was 3. That's 3. So that's technically, if you go 3 months, all 600 of those homes will be sold.
Will be sold.
Yeah.
Yeah,
and
it's a little more complex than that.
What's the lowest?
We don't need to get in the weeds.
What's the lowest? What's the lowest months of inventory we've ever seen?
What I've ever seen?
Yeah,
is less than one
less
month.
than 1 month of inventory.
Yeah, when you have a run,
hot market.
That is an incredibly hot market, and we saw that actually. When was that? I think it was 2005.
Oh wow.
I think 2005 was like that. We also had low inventory at the beginning of COVID.
Mm-hmm.
That was really tough. But then once they dumped
low.
interest rates, it went ape crazy.
Yeah, so it might have gotten close to that number in 2020 or 2021, maybe.
Yeah, possibly.
Yeah.
I mean, it's it's incredible.
So
you see this stuff.
What about the most amount of months?
Oh my gosh. Who?
Of inventory.
Well, I've been in this business all my life, so let's roll back. And most people weren't born by this time that are listening to this podcast, probably. But 1981.
Really? That's the most you've seen.
18% interest rates.
Yeah.
So suck it up and enjoy the 6.5% to 7%.
Yeah.
Because we had 18% rates. Yeah. The SNLs collapsed. There were a lot of reasons why that happened, but. That lasted a few years, and then it eventually went down. Yeah. I mean, we went to a local bar here, and we toasted. When it went over 10%, we go, "Oh, we'll never see 10% ever again." We were all crying in our beer, but we still did transactions. But it was like you could not get rid of a house. The other thing, the other period was the mid '90s.
Inventory was pretty high.
Inventory was very high. So if you wanted to sell a house, I'd moved to Sacramento around 96, I think it was.
Okay.
Whatever, I was selling real estate there and had a mortgage company at that time too.
Wow.
And I think interest rates were 8.5.
Okay.
I think 8.5, 9, 8.5, 8. It started. The rates started to descend after 96.
Yeah.
Again, you probably weren't born yet.
96? Oh, yeah. I was 16.
But anyway, so it was, there was a lot of inventory. And so sellers, in order to get their home sold, we would ask them, paint the interior of your house, do your pest work, anything that's broken, fix it, because we want to make it easy as possible so you can get it sold.
Yeah. Yeah.
And,
if they had to sell,
and they would do that. They would do everything. And it was fabulous because transactions were much easier then. They would do all the reports, and even if they didn't have the money to do it, they would get a home inspection, and then we would have subcontractors figure out what it would cost, and we would negotiate and massage the deal so they could get moved. But that's what it took.
Wow.
Yeah. And then the market turned.
Yeah.
And interest rates came down, and the economy turned, and the rest is history.
Yeah, no, that's cool.
So
yeah, so now basically 3 months is pretty good
3 months is great.
for a seller.
A seller, if you meet the market, you're going to get that home sold.
And for a buyer, because you can start getting that appreciation.
Absolutely.
Yeah.
You know, the thing for a buyer is, in my view, and I've bought and sold a lot of property, a lot of times I flip property, and had I kept the property, I would have made as much money with less risk by just getting in and holding on to it, and then moving into it, like just buying my first property, moving into it, let it rise, accumulate more money, buy my next property, rent the one that I was in, but just getting in the property. One of the things that I see some buyers make is they're renting and the house is pretty nice. You know, but they're spending big money on rent.
Yeah, they're renting on a nice house.
They're renting a nice house, and you're flushing your money down the toilet.
Yeah.
Right?
Yeah.
Pretty much.
Yeah.
You know, but if you could step back and go, you know, I'm going to step back and step down a little bit. My first house is going to be my first investment property.
Yeah, absolutely.
2 years, 3 years from now, I'm moving up the food chain.
Yeah.
And so getting that idea and just like, okay, I'm going to tough it out. I'm just going to accessorize this house and make it nice, right? But it's going to be smaller.
Yeah, let me ask you this. What do you think the biggest fear is right now with buyers in general?
With buyers in general?
Yeah.
I think they're afraid of the payment and not truly understanding the benefits of home ownership.
Yeah.
And I think there's a little bit of uncertainty. We were talking about politics right now.
Yeah.
You know, we're in this whole race for the presidency, and there's a lot of unknown.
Every 4 years.
And we're not talking about which side you're on, because we don't care about that. I mean, you might care, but that's not part of this
What you're saying is there's uncertainty right now.
Yeah, whenever there's uncertainty, people hold back, right? The confused mind says no.
Yes.
Well, sometimes you have to have a little courage, and that goes to your advantage if...
Wow, I love that.
Right?
Yeah, absolutely. 100%.
Yeah. Courage can give you advantage in a market like this. I mean, Warren Buffett says when prices are high and crazy, you know, he's holding his money, you know, and he's waiting for the right deal.
And then when the newspaper deliverer guy says, "Get in the stock market,"
that's
a
little bit of a problem.
Yeah.
You know, but with housing now, that the thing about it that I think is what's going to happen here locally is I'm just seeing all this employment that is coming to town. You have a lot of medical,
so much opportunity,
a lot of opportunity without a lot of increase in inventory. There's a lot of there's not a lot of building going on that's affordable. So if you're in a home, it just means that, you know, your home is becoming more and more valuable.
If you own a house right now, long term, just keep on keeping on. Patient.
Keep on keeping on.
So I heard a definition of patience, because, you know, I think it relates, because with buyers, you know, some buyers, they want to get in and, you know, they want to be able, I want to turn this around and sell it in a year and make sure I don't lose my butt.
Right.
Well, it's patience. So like the definition of patience I heard is finding something else to keep your attention on. It's true, you know, like if I'm sitting there watching a flower grow, I'm waiting for it and waiting for it. But if I'm just doing my thing every day, all of a sudden 3 weeks later, all of a sudden there's a flower there.
A beautiful
and I was
flower.
I was a patient. I was being patient,
Right.
because my mind and focus was on something else.
Right.
So he said the definition of patience is focusing on finding something else to put your mind on or focus on.
Right.
So if you're an owner and you own a house, or if you are a buyer, buy the house or keep owning the house and find something else to keep your mind occupied.
So I want to bring something up about rentals. So you go, well, I want to rent, and I don't want responsibility, and I'm going to save all this money because I'm renting. And there's a fallacy in that, because when you're renting, you're buying a house for somebody else. Essentially, that's really it.
Yeah.
So you're losing that opportunity of appreciation, of the tax write-offs, of a forced savings account.
Right.
Right, because you have to put your money in there and you're paying the principal down. In the beginning, it's not a lot, but if you play the long game and you work with it, you can actually, increase your principal payments.
Oh, yeah.
Yeah.
Long game,
Along riding with your tax write-offs. And
Well, not just that, but the income's going to continue to go up.
Right.
And that's what a lot of people don't understand or don't think about.
Inflation.
Income going to continue to go up. And minimum wage keeps going up.
Well, minimum wage, and then say, as you're in your job, depending upon your age group and where you're at in your job, you're generally moving up. But you have all these factors working for you. But when you rent, inflation works against you.
Yes.
Especially in the greater Redding, Shasta County area, because as
Your wages
employment
aren't keeping
comes,
up.
new people come, and you have restricted growth in housing, rents go up.
Yeah.
And this is the other thing that I've seen over and over and over again. You go, oh, yeah, I'm paying my rent, no big deal. Well, what happens now, and I'm seeing this a lot because I'm getting a lot of phone calls from people that own rental properties, and they've owned them for 30 years, and they're baby boomers, and they are cashing out.
Wow.
So guess what's going to happen to you? You're going to get a 30 or 60-day notice.
There's a lot.
How expensive and what a pain in the neck it is to move.
Another deposit, and then not getting your deposit back potentially.
Right. But having to compete for a new rental, and it's going to be more expensive. It's not getting cheaper, right?
Yeah. No.
We're not seeing that.
No, absolutely not.
No, there's not a glut of housing and a glut of rentals.
Well, the shortage of housing is hard for not just buyers, but also renters finding a place to rent.
You're right.
Yeah. So it's lack of housing. There's some good developments coming in with K2 apartments and stuff, but still
that's all is pretty much Section 8 kind of stuff.
Yeah,
I mean, a lot of people in Shasta County will qualify for that.
But it's
Don't
not
get me wrong.
It's not like a comparable to what you're saying, like a house or something. Yeah.
Correct. Or you're renting a duplex, or
for a family
you're
size
one
of
step
2 to 3. Yeah.
You need a yard. You got a dog, or you got a boat, or you got a car you're working on, or your wife has a quilting machine in the garage. All that stuff, and you're one step away from home ownership.
Yeah.
And so the thing about it is you're at risk of being evicted, right? And I see a bunch of people, I've been in this rental and I got 2 dogs and all that.
It happens all the time.
Then the people that own that house, I got to sell it, I'm cashing out. I'm done with this stuff. And now you have 2 dogs. You have no assets, and you may not have enough cash to really deal with
another
new deposits.
Another challenge for renters, and I know we're hitting the renter pretty hard.
Pretty hard. Sorry, guys, but this is the truth. You need to hear this.
Another challenge for renters is, for me as a homeowner and an investor, I own some rentals. I don't want to do long term.
Right.
I mean, some people do. Don't get me wrong. Some people do, because I would rather do, because of the technology, I could do daily, or I could do what you call midterm. I really like midterm. And the reason why I like it is because I can sell it if I needed to after, let's say I do, want to sell this house and upgrade it.
Right.
To a 4-plex or something. Well, I could then sell it. And so therefore you have all these midterm and daily rentals that renters can't get long-term rentals.
Right.
So that's hard for them, which also drives the price up for the long-term rental.
Exactly.
Yeah,
no,
which
that's true.
It's it's hard because, a lot of renters get frustrated with that.
Oh yeah, absolutely. But the reality is you can either buy somebody else a house or
Yeah.
you can buy a house
Yeah.
and have a retirement.
Yeah.
And if you get really savvy, you can build a lot of wealth.
Yeah.
Absolutely. It's probably the number one wealth strategy for
Leverage.
the average person.
Yeah. Huge leverage.
A huge leverage.
Yeah.
There's other factors too, so you as a lender and me as a former lender, but now, just really focused on real estate, we want our people to win. And so it isn't just a strategy of getting out of a rental and buying a house. There's a strategy of we're here to help advise you how to improve your credit.
Yeah.
We're encouraging you to, learn more about your craft as you grow in your industry. Pay down your debt, keep it under control.
Yeah.
What's the number one thing with credit cards? Do you go over 50% of their available balance or not?
Absolutely not. Never.
Never. You're better off to have more credit cards and stay below that 50% and make those payments.
Correct. Yeah, absolutely.
And always have a little balance.
Absolutely.
Right?
Yep.
I mean, things like that, little strategies like that can drive your credit score up to 800.
Yep. Yeah, absolutely.
Does an 800 credit score get better than a 640?
Oh, it gives you so much more possibility on that mortgage, so much more. But it's not just the interest rate that people think about, but it's also if you don't have that big, large down payment, you also get a massive discount on mortgage insurance.
Yes.
So like if you have an 800 credit score, or it's even 740, 750 credit score, way cheaper mortgage insurance than what an FHA loan is.
So you have a lot more opportunities to save money and
Keep your
build
payment
wealth.
lower, yeah.
Right.
Yeah, absolutely.
Pretty incredible, huh?
Yeah.
Yeah. It's a pretty amazing game when you start getting into it and then start understanding how it can really work for you.
Yeah.
But you got to get in the game.
You got to get in the game. Yeah, you got to get in the game. So obviously, I mean, I know your stance, but, for the next 6 months, what are you thinking we see, with home prices and interest
I think
rate?
they're
could
just
give my
going to
2 cents on
gradually
interest
continue
rates and
to go up based upon what we're seeing.
Yeah.
And as more people, I really think from talking politics, or at least the presidential, whoever gets in, then everybody will know what they're dealing with. There's going to be more
certainty.
More certainty, less confusion.
Yeah.
So more people will be going into the market, and I think that's going to push prices up.
Mm-hmm. Yeah, I agree with that. I get a lot of questions like we talked about in the beginning is, I think rates will come down because it's an election year.
Nah, that doesn't. Well, let's talk about, people are hoping the Federal Reserve, this, that, whatever, and they focus on the Federal Reserve, but it's really the bond market.
Yeah, it's the bond market.
And the bond market is tied to inflation numbers.
Correct.
Is that correct?
100% correct.
Okay, why don't you explain that in layman's terms, how that works?
Yeah, so essentially, how would I explain inflation? So more dollars chasing fewer goods. So inflation happens when they essentially print more money and there's not enough goods, and so it drives prices higher. Right. When there's more demand on things, well, what happens is the government doesn't want us to have like a 10, 12, 13, 14% inflation.
Oh no, that's
so they got to slow that down.
Right.
So what do you do to slow it down? Well, what you do is you try to take money back out of the economy.
Right.
And not have as many dollars there. You got to take money out, and that's what they've been doing. Yeah. To slow down inflation. And inflation was as high as like 9-10%, I think, in 2020, late 2022 and early 2023. But it's come down since. So interest rates, so 30-year fixed mortgages. So think of it like this. You have $100,000.
Okay.
And you're going to invest that for 30 years because that's what these mortgages are. They're 30-year
mortgage
notes. Yeah. So you have $100,000. You invest let's say you're coming into retirement. You want a fixed rate of return. Right on your money. So if you think of it like you're borrowing your own money, you're going to buy a mortgage. Well, that mortgage is going to give you a certain percent every month. Well, it doesn't make sense when you're only getting a 3% because interest rates are at 3%. Right?
Okay.
It doesn't make sense for you to get 3% over 30 years when the price of milk is going up and your gas is going up and it's fixed income. You're getting that 3%, and all of a sudden everything around you is going up in price. Well,
Right.
That doesn't make sense. So now you have to get rid of that 3%, and you have to figure out how to get 6% or keep up with the inflation of the higher priced milk and the higher priced eggs and the higher priced gas and the higher priced rent.
Right.
Yeah. So that's my best explanation of inflation.
Right.
Yeah.
Well, and there always will be inflation because the other thing that happens in monetary policy is
It's a mandate.
It's mandated that we need about 2% inflation because new dollars need to pay for cheaper dollars in the past. And it's kind of a weird concept when you first get your head around it. It's like, well, how's that work? Well, it's like you're discounting the money. You know, your dollar's going farther in a way, paying off old debt. Because
it's such a cool thing. I mean, a 30-year fixed mortgage is so cool. I mean, think about everyone that got a 30-year mortgage at 3%. They're reaping the benefit of inflation because now they have this debt. They're only paying 3% on that money. Right. And so they're taking more dollars because now there's more dollars in the economy. And they might be getting paid more. And chasing down this old debt, this old debt that's at 3%. Yeah.
Right. And that's actually created one of the reasons why housing's going up because people that are sitting on those 3% loans, they do not want to give them up.
They're reaping the benefits.
So a lot of the phone calls that I'm getting for sellers, all you sellers out there that are baby boomers or traditionalists, anybody that's really kind of over 60, they're retiring, you're on acreage, you got a big house, or you know, you're older and you can't deal with steps anymore. We see a lot of that. You know, we see those houses coming on the market. They either own them all cash and so they're able to move easily, but if they have debt on them, they go, I don't really want to sell. It's hard. It's a hard call. Something catastrophic usually has to happen. The kids step in and put mom and dad in a home or the hospital or whatever. But so we're seeing those houses go on the market, you know, but people that are in 3 and 2 and, you know, it's perfect size for them, they're healthy or whatever, they are not coming on the market. I mean, you got to have death, divorce, you know, bunch of kids.
You could think of it like this too. So with interest rates being at high 6s, low 7s right now,
which is a good rate.
It's a good rate. So you could think of the same thing that the 3% guy got, because what if, you know, what if inflation does go rampant again? Well, then that means rates would go to 9-10%. And then you're sitting there with a nice juicy 7% rate, and now rates are at 10%. You have a good, excellent rate. And the reason why those 10% rates are there is because of inflation. What does that mean? It means everyone's making more money.
Right.
And so you're you know, so it's like you're kind of getting the best of both worlds out here almost.
Yeah.
By what you're saying is chasing down old dollars with new debt.
Well, one of the things that a lot of people may not realize or they don't want to hear, America's in the process of reshoring back to the Northern Hemisphere. Our largest trading partners for the United States is Canada and Mexico.
They're working on moving away from China?
China.
Okay.
And that's been going on. And there's a number of reasons for that. You know, there's a certain economist that I listen to, and they really talk about it.
That's interesting. I didn't know that.
But when you reshore, it costs, there's a lot of capital improvements. You have to build the factories. You have to educate the workers. So you have a lot of infrastructure investment. That causes inflation.
Interesting.
Now, they're estimating, you know, close to 5 to 10 years of a certain amount of inflation as they're taking jobs out of China.
And bring them back in.
This is what's interesting to me is Mexico assembly is cheaper than China now.
What? I didn't know that.
Check that out.
Wow.
So they're reshoring over there. There's other countries in Southeast Asia that they're reshoring to. You know, but all that transfer of assembly, technology, new factories, all that stuff. It's part of the thing that we're dealing with inflation. And just think about semiconductors. They're building major chip factories in outside of Phoenix or in Arizona.
Are they really?
Oh, huge.
Yeah, I mean, that's great.
Intel, and I believe
really,
there's
really
another
good.
one.
That's
The
really good. We
Taiwan
need that.
Semiconductor. They're putting a plant there.
We can export from here.
Well, what we
help
want
our
to do is
exports.
control the high-end technology.
Yeah. That would be really good.
Yeah, there's, just think about that. And also, Denise, our daughter, is in Texas, and in Sherman, they're $30 billion assembly plant. Just crazy stuff that's going on because a lot of that has to do with national security.
Yeah.
Right, because we're messing. China's like
China,
Russia, America.
Yeah.
It's like, oh, it's a problem.
Yeah.
And so we're bringing this stuff back so we have what we need in our modern society and in our capitalistic
that's good.
society.
I didn't know that. That's good. That's cool.
Yeah. That's the big picture.
Yeah, that's big. So I'm gonna. I was watching. Speaking of technology, the robots, Elon Musk.
Right.
This is
off
topic.
Hopefully they won't be showing houses.
Yeah, I don't think so.
No, yeah.
But they will be making spaghetti and doing my laundry, and so I was like, oh wow, that's cool. It seems like it's closer than I thought.
Oh,
to
robotics,
having those in our houses.
Well, and there's different types of robotics. There's manufacturing, and then there's personal potential robotics. But we think of robotics where, there's a kind of a humanoid serving us and all that. Yeah. Well, that's pretty expensive stuff, right?
Yeah.
Yeah. So, but there may be partial robotics doing things in technology that can be mass produced cheaply. Yeah. But if you had to go out and buy that robot, it's like buying a Lamborghini, How many people can buy a Lamborghini?
That's true. Yeah, that's true. I just thought it was funny talking about
it is
robotics and the chips and stuff.
Yeah. It's fascinating.
Yeah. So, wow. So, anything else you want to share? Is there any other?
Not really. I think we kind of covered a lot today.
Yeah. I think that wraps it up for the first half of the year at least.
Yeah.
To sum it all up, it's still a strong market, strong real estate market.
Real estate market, and it's a good time for buyers to get in. You just have to be aware of what you're doing with your finances, with your career, with everything that you're doing. Stop going to Starbucks so much. Put it in your pocket. Yeah. Just a little story to end this. So a number of years ago, I decided that I wanted to do something for my wife. And so I just didn't tell her, but I didn't order a drink going out to dinner for a year and a half. And on her birthday, guess how much money I gave her? This is just like, don't buy a soda, don't buy a cocktail.
No way.
Or, don't buy the second cocktail because I'm going to have a cocktail. But anyway, $1,800.
No way.
On that one simple thing. So, I mean, $1,800 is $1,800.
Well, divided by 12 is what is that, 3? No, that's like 2. No. What is that, 1,800? I'm going to do the math on that. It's $900. 990, 1,800 divided by 12.
You can do this, I believe.
$150 a month.
Right.
$150 a month.
Well, imagine if both of you, say you're a couple.
300 a month. That's $300 a month will get you an extra
$3,600 a year.
Yeah, it'll get you an extra almost $50,000 in a home.
So if you did that 3 years, you'd have a good down payment.
There you go.
Right. I mean, it's little stuff like that.
Yeah.
Yeah,
I like that.
Yeah. Anyway, that's a story. Something to keep in mind. Just watch your budget. Be smart. Get a goal. If you have a partner, get congruent together. Have good conversations and talk to Pete.
There you go.
Really, you know, you need a team to figure this out.
Yeah, talk to Wayne too. I mean, you know, if you're thinking about selling your home in the next 12 months, you really should start preparing today.
Yeah. And it's free of charge. We can help you figure out what to fix, what to do, timing. You know, we're going to be there for you. We have a lot of great subcontractors, and we're going to tell you the truth about, you know, what's going on in the marketplace. A little side note. So 2 years ago, we had a friend come to us. She had a nice house, big house, pool, all that. And we were looking at it, and she goes, well, what's my house worth? So 2 years ago, we said, oh, it's worth like $775,000. Well, just today we looked at it. It's up $200,000 here in Reading.
Holy moly!
$200,000. Wow! 2 years.
Yeah, that's amazing.
How hard would you have to work to save $200,000?
That's leverage.
How much taxes would you have to pay to get that $200,000? So that's leverage. Now she's on her. You know, this is her fourth or fifth house. You know, she's changing her whole thing. She's downsizing. But that's pretty amazing. I was awesome. Like, wow, the renting market is hot.
Yeah.
So anyway,
I love that.
Let's end with that.
That's a great ending. Yeah, definitely. Thank you, Wayne.
Thank you, Pete.
Yeah.
Okay, awesome. We'll see you next month.
Yeah. Yeah.